We are going to study from Accountancy 1. This is block number 1, Accounting Fundamental. We will be studying Unit 2 and 3, the accounting process and cash book and bank reconciliation. The topics which we are going to cover are introduction, subdivision of journal, cash book, single column cash book, 2-column cash book, 3-column cash book, bank reconciliation statement, causes of difference, what is bank reconciliation statement, preparation of bank reconciliation statement, recording and posting the petty cash book, when then is overdraft, adjusting the cash book balance, advantage of bank reconciliation statement, petty cash book. In this unit, we will learn about the most important subsidiary books called cash book. We shall discuss various type of cash book and study how transactions are recorded in each type of book and posted from cash book to ledger. We will also learn about the banking transaction, their recording in 3-column cash book and the preparation of bank reconciliation statement. Now, we are discuss on subdivision of journal. So, number 1 is cash book. It is used for recording all cash receipts and cash payment, including cash purchase and cash sale. Number 2 is purchase journal. It is used for recording all credit purchase of goods. Number 3 is sales journal. It is used for recording all credit sales of goods. Next one is purchase return journal. It is used for recording the return of goods to supplier. It is also known as returns outwards book. Next is sales return journal. It is used for recording the return of goods by customer. It is also known as return inward books. Next one is bill receivable journal. This book is meant for recording transaction relating to bill of exchange and promissory note received from debtors. Next one is bills payable journal. This book is meant for recording bill of exchange and promissory notes accepted by the business in favor of creditors. Next topic is cash book. So, a cash book is financial journal that contain all cash receipts and payments including bank deposit and withdrawals. Entries in the cash book are then posted into the journal ledger. There are different type of cash book in used by the business. There are simple or single column cash book, 2 or double column cash book, 3 or triple column cash book. Here is the single column cash book. It is like an ordinary cash book. The rule of posting the cash book, we must remember that there is no need to open a cash account. It is because when a cash transaction is recorded in the cash book, the posting of cash aspect of the transaction stand duly covered. We are to make posting only to the other concerned accounts in the ledger in order to complete the double entry. The rules of posting are: for all transaction enter on the debit side of the cash book, credit the concerned account in the ledger by writing by cash account in the particular column. And the second rule is for all transaction enter to the credit side of the cash book, debit the concerned accounts in the ledger by writing to cash account in the particular column. Format of simple cash book. The first column is date. The date of transaction is written in this column in 2 lines. In the first line, the year, and the second line, the name of month followed by the actual date. Next one is particulars. In this column, the name of the opposite account is written. Below this is written the narrator of the transaction. Next one is ledger folio, LF. The page number of the ledger where the concerned opposite account has been opened is written in this column. This will help to locate the account from the ledger. It may be noted that in a ledger account is written as reference, while in a cash book LF is written. It is so because cash transactions are not recorded in any journal. Number 4 is amount. The amount of the transaction is recorded in this column. The amount of cash received is recorded on the debit side in amount column, and amount of cash paid is recorded on the credit side in the column. Next one is a voucher number, V number. The voucher number of each item of receipts and payment is also written. A voucher is necessary for each item of receipt and payment. Generally, a voucher has a serial number and this number is written in this column. When the cash is received from a debtor or customer, generally a receipt or a cash memo is issued to the debtor, which is called receipt voucher. Again, when money is paid to the creditor or supplier, a receipt is obtained from him, which is called a payment voucher. Cash transactions are recorded in the cash book on the basis of receipt, voucher and payment voucher. Thus, a document evidencing cash receipts and payment and forming the basis for making entries in the cash book is called cash voucher. 2-column cash book. 2-column or double column cash book. When discount is allowed on the receipt of cash and discount is received when payment is made to supplier, it becomes desirable to add discount column along with cash on both sides of the cash book. Here is the format of the 2-column cash book. 3-column cash book is a cash book which has 3 columns on each side. 1 column to record discount allowed, another to record discount received, another to record cash transaction, and yet another to record bank transaction. In other words, we can say that triple or 3-column cash book represent 2 accounts, cash account and bank account. Here is the format of 3-column cash book. Now, bank reconciliation statement. So, what is bank reconciliation statement? Answer is here. Bank reconciliation statement can be defined as a statement which reconcile the balance as per cash book and the balance as per passbook, showing all causes of difference between the two. The purpose of the bank reconciliation statement. Due to the timing difference, omissions and errors made by the bank or the firm itself, the balance of the bank statement and the bank account in the cash book rarely agree. Next is bank reconciliation statement can be used. Bank reconciliation statement. The purpose of bank reconciliation statement, due to the timing difference, omissions and errors made by the bank or the firm itself, the balance of the bank statement and the bank account in the cash book rarely agree. Bank reconciliation statement can be used to explain the reason for the difference and to identify errors and omissions in both documents so that correction can be made as soon as possible. Causes of difference. First of all, uncredited items. They are deposit paid into bank. These items occurred too close to the cut-off date of the bank statement and so do not appear on the statement. They will appear on the next statement. Second is unpresented check. They are checks issued by the firm that have not been presented to its bank for the payment. Next is standing orders. They are standing instruction from the firm to the bank to make regular payments. Next is direct debits. They are payments made directly through the bank. Bank charges. They are charges made by the bank to the company for banking service used. Next is dishonor checks. They are checks deposited but subsequently returned by the bank due to the failure of the drawee to pay. Next is credit transfer or direct credit. They are money received from customer directly through the banking system. Next one is interest allowed by the bank. They are interest received for deposit or a fixed deposit. Preparation of bank reconciliation statement. The bank reconciliation statement is prepared at the end of a quarter, half year or a year as the firm may consider described and convenient. It can be prepared in two ways. First one is take the balance as per cash book. As the starting point, adjust the effect of each item causing the difference and arrive at the balance as per passbook. The next one is take the balance as per passbook as the starting point, adjust the effects of each item causing the difference and arrive at the balance as per cash book. Preparation of bank reconciliation statement. List the item which would generally be added and subtracted when cash balance is used as the starting point. To be added, check issue but not yet presented, interest allowed by the bank, interest and dividend collected but not recorded in the cash book, direct deposit by customer in the firm's bank account. To be subtracted, check deposit but not yet collected, bank charges, interest on overdraft, amounts paid by the bank under standing instruction but not recorded in the cash book. Check dishonor but no entry made in the cash book for the dishonor. So, move on to overdraft. An overdraft occurs when money is withdrawn from a bank account and the available balance goes below zero. In this situation, the account is said to be overdrawn. Advantage of bank reconciliation statement. The very first is accurate balance. As you start cash transaction, you record this transaction in your financial records, reducing your bank account's balance. The bank balance in your financial record is not your true bank balance because some of these transactions are still outstanding and have not yet cleared by the bank. An outstanding transaction is a transaction you have started that your bank has not yet processed. A transaction clear the bank when your bank process the transaction. A bank reconciliation reveals which cash transaction have cleared the bank and which cash transaction are still outstanding. Checks are the most common type of transactions that remain open at the end of the statement period. But if you make a deposit at the end of the month, your financial institutions might not clear it as of the statement ending date. Next one is prevent thefts. A bank reconciliation in which you compare your transaction with your bank financial transaction will help you spot transactions your bank has recorded that are not in your records. It is a common practice to record bank fee as you complete your reconciliation. It is also may be a transaction you are forgotten to record. Further examination of original document, if available, should relieve this. Comparing transaction may also relieve a transaction initiated by an unauthorized person who is attempting to steal money out of your account. It is also might be a transaction you forgotten to record. Further examination of original documents, if available, should reveal this. Comparing transaction might also reveal transaction initiated by an unauthorized person who is attempting to steal money out of your account. Next one is prevent mistakes. A good financial institute put procedures in place to avoid making a mistake in your account, but sometimes mistakes do happen. A common mistake financial institute make a simple entry error. Next one is account in good standing. Reconciling your financial account, keep your account in good standing when you know what you have available in the account to spend. You are less likely to overdraft the account, meaning that you withdraw or attempt to withdraw more money than you have in the account. Overdrawing your account will negatively affect your credit score. Next one is accounts in good standing. Reconciling your financial accounts, keep your accounts in good standing when you know what you have available in the account to spend. You are less likely to overdraw the amount, meaning that you withdraw or attempt to withdraw more money than you have in the account. Overdrawing your account will negatively affect your credit source and your financial institution may charge you fee. Some banks provide bank overdraft protection, but often the institution will charge your company a fee for using this service. If you do not have overdraft protection on your account, the consequences are higher. Often, the financial institute will charge you a fee for the check and refuse to cash it. The person you sent the check will then receive notice that your check bounced and his financial institution will charge him a fee. This type of indicate can negatively affect your company's reputation. Next slide is petty cash book. So, the petty cash book is a format summarization of petty cash expenditure shortage by the date. In most cases, the petty cash book is an actual ledger book rather than a computer record. Thus, the book is a part of the manual record keeping system. The fundamental difference between the main cash book and the petty cash book is that only petty expenses are recorded in the petty cash book. No receipt, however small it may be, is recorded in it. But in the main cash book, all receipts and large expenses are recorded. System of petty cash accounting. Open system. Under this system, the petty cashier at first receiver from the chief cashier a fixed sum of money for meeting petty cash expenses. As soon as the said amount is spent, the chief cashier again pay the required sum to the petty cashier. Next is fixed advance system. Under this system, the petty cashier receive from the chief cashier a fixed sum of money for a fixed period for a time. Impressed system. This system is generally followed by the most of the business concern. Under this system, the total petty expenses for a particular period are estimated and that amount is advanced by the chief cashier to the petty cashier. This amount is called impressed cash. On the expiry of this fixed period of petty cashier prepare a statement of his expense and submit it to the chief cashier. This statement is known as statement of petty cash book. The chief cashier examine the statement and if he find it correct, hand over the petty cashier an amount equal to the amount actually spent. This amount plus the amount lying unspent with the petty cashier will be equal to the impressed cash. Now the time is to sum up the unit. When the number of transactions in a business are too larger, it becomes difficult to record all them in the journal. Hence, it is subdivided into a number of special journals called subsidiary books. All cash transactions are recorded in cash book. There are three types of cash book: simple cash book, 2-column cash book, and 3-column cash book. A petty cash book can also be prepared for recording payments of various petty expenses. That's all for this unit. Thank you so much.